In this lesson, we are going to look at the difference between buying, renting, or leasing. We're going to solve some problems by analyzing renting, leasing, and buying options. A lease is a contract for purchasing the use of property, such as a building or vehicle, from another, the lessor, for a specified period. Equity is the difference between the value of an item and the amount still owing on it. It can be thought of as the portion owned. For example, if a $25,000 down payment is made on a $230,000 home, $205,000 is still owing, and $25,000 is the equity or portion owned. Equity can make buying a house a form of investment. Appreciation is an increase in the value of an asset over time, and depreciation is the decrease in the value of the asset over time. Appreciation and depreciation affect the value of a piece of property and should be considered when making decisions about renting, buying, or leasing based on that particular situation. They are usually expressed as a rate per annum. Disposable income is the amount of income that someone has available to spend after all regular expenses and taxes have been deducted. An asset is an item or portion of an item owned, also known as property. Assets include such items as real estate, investment portfolios, vehicles, art, and gems. When deciding whether to rent, buy, with or without financing, or lease, each situation is unique. A cost and benefit analysis should take everything into account. Costs include the initial costs and fees, short-term costs, long-term costs, disposable income, the cost of financing, depreciation and appreciation, penalties for breaking contracts, and equity. Benefits would include convenience, commitments, flexibility, and personal needs or wants, such as how often you want to buy a new car. Since each situation is unique, it is impossible to generalize about whether renting, leasing, or buying is best. When renting, leasing, and buying, you often need to make payments up front. Some payments go toward the overall cost, such as a down payment on a house or a lease deposit, and the first and last month's rent. Other deposits, such as rental damage deposit, are refunded at a later date. The cardio equipment at a fitness studio needs to be replaced. The cost of new equipment is $16,500. The owner of the studio does not have enough cash to pay for it. She has two options. She can use a line of credit with an interest rate of 12.4% compounded monthly, or she could lease the equipment for 2 years for $1,000 down and $480 each month. What is the cost of buying with a line of credit if the owner pays off the loan in 2 years? So let's have a look. So basically we're going to calculate if she takes a loan out and she's going to pay it off in 2 years. She's going to make monthly payments, so our N is 2 times 12. The interest rate on her line of credit is 12.4. She is borrowing $16,500. We don't know what her monthly payment's going to be right now. Future value will be 0. She is going to make 12 payments per year because she's making monthly payments. And the compounding on this line of credit is monthly, so 12. When we do this calculation, we find out her monthly payment would need to be $779.80. So to calculate how much the cost of the loan would be, or to how much the cost of buying using credit would be, she's making monthly payments, so 12 of these a year for 2 years. She is going to end up paying $18,715.20. That's how much it's going to cost her to buy it. Then she's going to own it. What is the cost of leasing for 2 years? Well, leasing was $1,000 down plus $480 each month. Now in 2 years, that would be 24 months. So when we calculate this out, it will cost her $12,520 to lease the equipment for 2 years. So you can look at that and we can talk about, okay, it's going to cost her more to buy it, but after 2 years she's going to own it. Whereas the cost of leasing for 2 years is less, she's not going to own it. But you might look at cost and benefit here. Let's look at part C and see if this plays a part of it. The equipment depreciates at 30% per year. So what is its value after 2 years? All right, so if she was still to have it, how much is it actually worth? So if it depreciates, what we do is we take the original amount and we need to subtract off the depreciation. The depreciation is 30% of the amount. So 30% is calculated as 0.3 when we are going to find the percent. So we're finding the percent of the original. After year 1, it's worth $11,550. So now we're starting with $11,550, and we need to find and subtract off 30% of that. We find out that after 2 years, it is worth $8,085. So now, should the owner buy or lease and explain? Really? There could be a variety of suggestions here, and it might come down to the preference of the owner. If she plans to use the equipment for only 2 years, she may choose to lease and then find some new equipment again and either buy or lease that. But if she's going to use the equipment for more than 2 years, if she feels in her fitness studio that equipment can be used for more than 2 years, she may decide to purchase the equipment. So it would depend upon her situation. It would depend upon typically how long she likes to use equipment in the studio. And so those are things that she would have to consider. The 10-year-old water heater in Tom's home has stopped working, so he needs a new one. Tom only works for minimum wage. After paying his monthly expenses, he has $35 disposable income left. He has an unused credit card that charges 18.7% compounded daily, so he has 2 options. Tom could lease from his utility company for $17.25 per month. This would include parts and service. Or he could buy a water heater for $712.99 plus an installation fee of $250 using his credit card. He could afford to pay no more than the $35 each month. So what costs are associated with buying and leasing? So if we start with his buying option. So if he buys this, he's going to have to put it on his credit card. We don't know how long it's going to take for him to pay this off. What we do know is that the interest rate is 18.7%. We would have to add the cost of the water heater plus the installation fee. So he would have to put $962.99 on credit. We know he can afford no more than $35 a month. The future value will be 0. He's going to have to do monthly payments, and the compounding is daily, so 365. So when we put this all into our calculator, we are going to find out that it is going to take him 36.3074 payments. That's how many payments he's going to have to make. So let's see what his cost is. He pays $35, and he's got to make 36.3074 of these. He is going to end up paying $1,270.76. That is his cost if he buys it. Now let's check the cost of leasing. Now, so that we can compare these two, let's consider him leasing as long as it would take for him to pay off the credit card. So it was 36.3074 payments, but leasing is only at $17.25 per month. So it will cost him $626.30 to lease. So basically half the price to lease. Now let's think about this. That was 36 payments, so 36 monthly payments, so about 3 years. 36 divided by 12. So this is assuming then that the water heater is going to be in for 3 years. So those are the costs associated with it. So what do you recommend for Tom? Well, you might suggest right now that he leases because it's a lower cost. With the leasing, you also get free repairs and service. So maybe that is something that also needs to be considered. If something happens in these 3 years to that water heater and Tom has bought it, he is also going to have to pay for the repairs and service. So because he's on such a tight budget already, it might make more sense for him to lease. Not only that, but then his monthly payment is only $17 versus the $35, so he's got some flexibility in his disposable income. However, after 3 years, he's going to have to continue leasing this water heater, whereas if he had bought it, he is now done with payments. So there's some things there for Tom to consider. Suppose that the life expectancy of a water heater is 8 years. Would this change your recommendation? Well, let's have a look. If we were to buy this, cost to purchase. So we've already figured out that if he bought it on credit, it's going to cost him $1,270.76. But now if he's going to lease for 8 years, so he's going to pay $1,725 a month for 8 years. It's going to cost him $1,656. So for 8 years, it's going to cost him about $300 to $400 more. Consider this again. In leasing, there's free service and repairs if something happens. Whereas if he bought, he's going to have to pay for anything to be repaired. If you are strictly looking at the cost, it would make more sense to buy it. And so those are things that would have to be considered. Would it be more beneficial to buy it because it will be cheaper? And let's hope that there's nothing that needs to be repaired. Then sure, it makes more sense to buy. However, this is the life expectancy is 8 years. What if it doesn't last 8 years? What if something breaks down? At least if you're leasing it, the company can take it back if there's problems. They will come and repair it. So there are things to definitely consider, and that's a cost and benefit analysis that a person has to look at when making these decisions.